Welcome back to our channel, where we delve into the fascinating world of investing. In today's video, we'll be exploring the concept of fundamental analysis and providing you with some real-life examples to help you understand its significance. So, what exactly is fundamental analysis? Well, it's a method used by investors to evaluate the intrinsic value of a stock or any other financial instrument. Rather than solely focusing on price movements, fundamental analysis delves into various factors that can affect the underlying asset's worth. Let's dive into our first example. Imagine you're considering investing in company ABC. As a fundamental analyst, you'd start by examining the company's financial statements, such as their balance sheet, income statement, and cash flow statement. By analyzing these documents, you can gain insights into the company's profitability, liquidity, debt levels, and overall financial health. You may also consider the company's competitive advantages, management team, and industry trends. Now, let's move on to our next example, where we'll explore how fundamental analysis can be applied to the stock market. Let's say you're interested in purchasing shares of XYZ Corporation. In this case, you'd evaluate the company's earnings per share, price-to-earnings ratio, dividend yield, and other relevant financial ratios. Furthermore, you might research the company's market position, growth prospects, and any upcoming product launches or regulatory changes that could impact their stock price. Remember, fundamental analysis is not just limited to stocks. It can also be applied to other financial instruments, such as bonds or commodities. To summarize, fundamental analysis provides investors with a comprehensive understanding of an asset's intrinsic value. By examining relevant financial data, industry trends, and other factors, investors can make more informed decisions. We hope this video has shed some light on the importance of fundamental analysis in the world of investing. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more insightful content. Until next time, happy investing. Disclaimer. The content on this YouTube about fundamental analysis is meant for educational purposes only. It is not financial or investment advice. The videos express the opinions of the creators and not YouTube. Use caution, do your own research, and consult professionals before making any investment decisions. Trading and investing involves risks. Only invest what you can afford to lose. We are not liable for any loss or damage, including, without limitation, any loss of profit that may arise directly or indirectly from the use of or reliance on the information provided. EPS, earnings per share. EPS, or earnings per share, is a financial metric that indicates the portion of a company's profit that is attributed to each outstanding share of common stock. It is commonly used by investors and analysts to assess a company's profitability on a per-share basis. EPS is calculated by dividing the net income, total earnings, of a company by the weighted average number of shares outstanding during a specific time period. The result represents the amount of profit generated per outstanding share. For example, let's assume company XYZ reported a net income of 1 million Indian rupees for the fiscal year and has 1 million shares outstanding throughout the year. To calculate EPS, divide the net income, 1 million Indian rupees, by the number of shares outstanding, 1 million, EPS equals 1 million Indian rupees / 1 million equals 1 Indian rupee. In this case, the EPS of company XYZ would be 1 Indian rupee per share. This means that for each share of common stock held by investors, the company generated 1 Indian rupee in profit. EPS plays a crucial role in determining a company's stock valuation, as it helps investors understand how much profit a company is generating relative to its outstanding shares. It also provides a basis for comparing the earnings performance of different companies within an industry and over time. Generally, a higher EPS is seen as a positive indicator of a company's profitability and attracts more investor interest. P ratio. P ratio, also known as the price-to-earnings ratio, is a financial metric used to determine the relative value of a company's stock by comparing its current stock price to its earnings per share, EPS. The formula to calculate the P/E ratio is simple. P/E ratio equals stock price / EPS. For example, let's say company XYZ has a current stock price of 50 Indian rupees per share, and its EPS is 5 Indian rupees. To calculate the P/E ratio, we divide the stock price, 50 Indian rupees, by the EPS, 5 Indian rupees. P/E ratio equals 50 Indian rupees / 5 Indian rupees equals 10. This means company XYZ has a P/E ratio of 10. It suggests that for every rupee of EPS, investors are willing to pay 10 Indian rupees. A low P/E ratio may indicate that the stock is undervalued, while a high P/E ratio may indicate that the stock is overvalued. The P/E ratio is commonly used by investors to compare the valuation of different companies within the same industry or the overall market. However, it should not be the sole determinant of investment decision-making, as it has limitations and should be analyzed in conjunction with other financial factors. EBITDA, earnings before interest, taxes, depreciation, and amortization. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a financial metric widely used to measure a company's profitability and cash flow before considering certain non-operating expenses. An example to understand EBITDA would be a manufacturing company that generated revenue of 500,000 units and had operating expenses of 250,000 units, including wages, utilities, and raw materials. Additionally, the company had depreciation and amortization expenses of 50,000 units, interest expenses of 20,000 units, and tax expenses of 30,000 units. To calculate EBITDA, we start with the operating profit or earnings before interest and taxes, EBIT, which is revenue minus operating expenses. 500,000 minus 250,000 is equal to 250,000 units. Then, we add back the depreciation and amortization expenses. 250,000 plus 50,000 is equal to 300,000 units. Finally, we obtain the EBITDA by adding back interest and tax expenses. 300,000 plus 20,000 plus 30,000 is equal to 350,000 units. In this example, the EBITDA of the manufacturing company would amount to 350,000 units, indicating its operating profitability before interest, taxes, depreciation, and amortization. Debt-equity ratio. Debt-equity ratio is a financial metric that shows the proportion of a company's total debt to its total equity. It helps ascertain the extent to which a company is financed through debt and equity. To calculate the debt-equity ratio, you divide the total debt of a company by its total equity. The formula is as follows. Debt-equity ratio equals total debt / total equity. Suppose XYZ Ltd has total debt of 1 million Indian rupees and total equity of 500,000 Indian rupees. Debt-equity ratio equals 1 million Indian rupees / 500,000 Indian rupees equals 2. This means that XYZ Ltd has a debt-equity ratio of 2. It implies that for every 1 unit of equity, the company has 2 units of debt. A higher debt-equity ratio indicates that a larger proportion of the company's financing comes from debt, which could potentially make it riskier as debt needs to be repaid with interest. On the other hand, a lower debt-equity ratio suggests that the company has a higher proportion of equity financing and may be considered more financially stable. ROE, return on equity. ROE stands for return on equity, which is a financial ratio used to measure the profitability and efficiency of a company in generating profits from the shareholders' investments. Suppose you invest 10,000 Indian rupees in a company by purchasing its shares. At the end of the year, that company earns a net profit of 2,000 Indian rupees. To calculate the ROE, we take the net profit, 2,000 Indian rupees, and divide it by the shareholders' equity, 10,000 Indian rupees. ROE equals net profit / shareholders' equity. ROE equals 2,000 Indian rupees / 10,000 Indian rupees. ROE equals 0.2 or 20%. In this example, the ROE is 20%, which means the company is generating a 20% return on each rupee invested by shareholders. It indicates that the company is efficient in utilizing the shareholders' equity to generate profits. A higher ROE is generally considered favorable as it portrays the company's ability to generate greater returns. However, it's essential to compare the ROE with industry benchmarks and historical data to gain a comprehensive understanding of the company's performance. ROCE, return on capital employed. ROCE stands for return on capital employed. It is a financial ratio that measures the profitability and efficiency of a company's capital investments. To calculate ROCE, you divide the operating profit, EBIT, by the capital employed, total assets, minus current liabilities. The result is expressed as a percentage. For example, let's say a company has an operating profit of 500,000 Indian rupees and its total assets are worth 10 million Indian rupees, while its current liabilities amount to 2 million Indian rupees. In this case, the capital employed would equal 8 million Indian rupees, 10 million Indian rupees minus 2 million Indian rupees. Using the formula, the ROCE would be ROCE equals operating profit / capital employed x 100 equals 500,000 Indian rupees divided by 8 million Indian rupees, multiply by 100, is equal to 0.0625 times 100 equals 6.25%. So, the company's return on capital employed, ROCE, would be 6.25%. This means that for every 1 Indian rupee invested in capital employed, the company generates 0.0625 Indian rupees, or 6.25 paise, in operating profits. ROCE is an important ratio as it helps indicate the overall efficiency and profitability of a company's investments. A higher ROCE generally reflects a better utilization of capital, showing that the company is generating more profits relative to the capital employed. Price-to-book, PB, ratio. The price-to-book, PB, ratio is a financial metric used to compare a company's market value to its book value. It is calculated by dividing the market price per share by the book value per share. The book value of a company represents the value of its assets minus liabilities, as stated on its balance sheet. It gives an indication of what shareholders would receive if the company were to be liquidated. On the other hand, the market price per share reflects the current value that investors are willing to pay for the company's shares. Let's say a company XYZ has a market price per share of 200 Indian rupees and a book value per share of 150 Indian rupees. In this case, the PB ratio would be calculated as follows. PB ratio equals market price per share / book value per share. PB ratio equals 200 Indian rupees divided by 150 Indian rupees equals 1.33. A PB ratio of 1.33 implies that the market price of XYZ shares is 1.33 times its book value. This figure can be used for comparison with industry peers or historical data to assess whether the stock is overvalued or undervalued. Please note that the PB ratio alone cannot provide a comprehensive picture of a company's financial health, and it should be used in combination with other financial ratios and analysis. Price-to-sales ratio. Price-to-sales ratio, PS ratio, is a financial metric used to evaluate a company's valuation by comparing its market capitalization, the total value of all its outstanding shares, to its total sales revenue. The PS ratio is calculated by dividing the market capitalization of a company by its annual sales revenue. It is also known as the revenue multiple. For example, let's say a company has a market capitalization of 1,000 Indian rupees crore, 1 crore equals 10 million, and its annual sales revenue is 500 Indian rupees crore. To calculate the PS ratio, we divide the market capitalization by the sales revenue. PS ratio equals market capitalization / annual sales revenue. PS ratio equals 1,000 Indian rupees crore / 500 Indian rupees crore. P/S ratio equals 2. In this example, the P/S ratio is 2. It indicates that the market value of the company is twice its annual sales revenue. Projected earnings growth. Projected earnings growth refers to the expected increase in a company's earnings over a specific period of time. It is a projection or estimation made by financial analysts or experts. For example, if a company's earnings per share, EPS, is 10 Indian rupees in the current year, and analysts predict that the EPS will grow at a rate of 15% per year for the next 5 years. The projected earnings growth would be calculated as follows. Year 1. Current EPS, 10 Indian rupees, projected EPS, 10 Indian rupees multiplied by 1 plus 0.15 equals 11.5 Indian rupees. Year 2. Current EPS, 11.5 Indian rupees, projected EPS, 11.5 Indian rupees multiplied by 1 plus 0.15 equals 13.23 Indian rupees. Year 3. Current EPS, 13.23 Indian rupees, projected EPS, 13.23 Indian rupees multiplied by 1 plus 0.15 equals 15.20 Indian rupees. Year 4. Current EPS, 15.20 Indian rupees, projected EPS, 15.20 Indian rupees multiplied by 1 plus 0.15 equals 17.48 Indian rupees. Year 5. Current EPS, 17.48 Indian rupees, projected EPS, 17.48 Indian rupees multiplied by 1 plus 0.15 equals 20.10 Indian rupees. Hence, in this example, the projected earnings growth for the next 5 years is expected to be 15% on an annual basis. Quick ratio. Quick ratio, also known as acid test ratio, is a financial metric used to measure a company's ability to pay off its current liabilities using its most liquid assets. It provides a more conservative measure of a company's liquidity compared to the current ratio. The formula for calculating the quick ratio is quick ratio equals cash plus marketable securities plus accounts receivable / current liabilities. For example, suppose a company has the following financial information. Cash, 50,000 Indian rupees. Marketable securities, 20,000 Indian rupees. Accounts receivable, 30,000 Indian rupees. Current liabilities, 60,000 Indian rupees. To calculate the quick ratio, we add the liquid assets, cash, marketable securities, and accounts receivable, and divide it by the current liabilities. Quick ratio equals 50,000 Indian rupees plus 20,000 Indian rupees plus 30,000 Indian rupees, divided by 60,000 Indian rupees. Quick ratio equals 100,000 Indian rupees divided by 60,000 Indian rupees. Quick ratio equals 1.67. In this example, the company has a quick ratio of 1.67. Indicating that it has 1.67 Indian rupees of liquid assets available to cover each rupee of its current liabilities. Generally, a quick ratio of 1 or higher is considered good because it indicates that the company has enough liquid assets to cover its current liabilities. However, what is considered a good ratio can vary depending on the industry and specific circumstances of the company. The price-to-revenue ratio, P/R ratio. The price-to-revenue ratio, P/R ratio, also known as the price/sales ratio, is a financial metric used to evaluate a company's valuation by comparing its market price per share to its total revenue per share. It is calculated by dividing the market price of a stock by its revenue per share. Let's assume company XYZ has a market price per share of 500 Indian rupees and revenue per share of 50 Indian rupees. The price-to-revenue ratio would be P/R ratio equals market price per share / revenue per share. P/R ratio equals 500 Indian rupees divided by 50 Indian rupees. P/R ratio equals 10. In this case, the price-to-revenue ratio of company XYZ would be 10. This means that investors are willing to pay 10 times the company's revenue per share to own its stock. Remember, a low P/R ratio indicates that a stock may be undervalued, while a high P/R ratio suggests that a stock is overvalued. The interpretation of the P/R ratio should always be done in comparison with other similar companies and industry norms. Dividend payout ratio. The dividend payout ratio is a financial metric used to determine the percentage of earnings that a company distributes to its shareholders in the form of dividends. It indicates the portion of net income that is returned to shareholders. The formula for calculating the dividend payout ratio is dividend payout ratio equals dividends per share / earnings per share. Assume a company has earnings per share of 10 Indian rupees and pays dividends per share of 3 Indian rupees. The dividend payout ratio would be dividend payout ratio equals 3 Indian rupees divided by 10 Indian rupees equals 0.3 or 30%. Therefore, in this example, the company's dividend payout ratio is 30%, indicating that it distributes 30% of its earnings as dividends to shareholders. Dividend yield ratio. The dividend yield ratio is a financial metric that indicates the annual dividend payment as a percentage of the current market price of a stock. It helps investors understand the return on investment they can receive from holding a particular stock based on its dividend payments. The formula to calculate dividend yield ratio is dividend yield ratio equals dividends per share divided by market price per share multiplied by 100. For example, let's assume that a company pays an annual dividend of 10 Indian rupees per share, and the current market price of the stock is 200 Indian rupees. Using the formula mentioned above, we can calculate the dividend yield ratio as follows. Dividend yield ratio equals 10 Indian rupees divided by 200 Indian rupees, multiply by 100. Dividend yield ratio is equal to 0.05 times 100. Dividend yield ratio equals 5%. Therefore, the dividend yield ratio for this particular stock is 5%. It means that, based on the stock's current market price, an investor can expect a return of 5% annually through dividend payments.